Back in 2007, a particular shape started forming on the S&P 500 chart. It was a pattern of a sharp climb, a shaky peak, and then a terrifying volatility that had some of Wall Street's brightest holding their breath. What happened next? Only the most devastating market crash since the Great Depression, a financial firestorm that torched over 57% from the market and vaporized trillions in wealth. Now fast forward to the autumn of 2025, fueled by a world-changing frenzy around artificial intelligence. That exact same shape is back. Analysts have laid out the charts on top of one another and similarity is haunting. In this video I'm going to show you the side-by-side data and other red flags and expert warnings that suggest history might be gearing up for a spectacular repeat performance. So to really get the weight of what's happening right now, we need to take a quick trip back in time. The year before 2008, for a lot of people, felt like a party. The economy was humming, innovation was everywhere, and the housing market seemed like a rocket that only went up. That core belief was that housing prices could never really fall on a national scale. That belief, that story became the fuel for one of the biggest display of financial arrogance in modern history. At its heart, the 2008 crisis was a housing bubble, but it wasn't just about houses, it was about the complex and toxic financial products built on top of them. Lenders chasing huge profits started handing out subprime mortgages to people with shaky credits, often with teaser rates that would explode into payments they couldn't afford. This wasn't just a few bad apples, it was a systemic rot. Then Wall Street's financial wizards worked their magic. They took thousands of these garbage mortgages, bundled them together, and somehow stamped them as safe, investment grade securities called collateral realized debt obligations or CDOs. They sold them to pension funds, big investors, and even entire countries, all disguised as safe and diversified. The whole system became a giant tangled web of risk. Everyone owned a piece of the poison, but no one knew how much. If you look at the S&P 500 chart from that time, you can see the market psychology playing out in real time. Through 2006 and into 2007, the market kept climbing, even with whisperings of trouble in housing. It hit an all-time high in October 2007. That was peak euphoria, the last party before the lights went out. Then the first tremors hit. In early 2008, the market started to look weak. It fell hard, then staged a convincing rally, a classic bull trap that tricked investors into thinking the worst was over. Many thought it was just a healthy correction, but under the surface, the subprime defaults were starting a chain reaction. Big firms that were leveraged to the eyeballs on these toxic assets, like Bear Stearns and Lehman Brothers, started to wobble. When Lehman Brothers finally went bankrupt in September 2008, the game was up. The illusion of safety shattered. The global financial system interconnectedness, once a strength, was now its fatal flaw. Credit markets froze, trust vanished, panic went global. The S&P 500 didn't just fall, it dove off a cliff. From its 2007 peak to the low in March 2009, it lost more than half its value. It was a brutal lesson in how fast euphoria turns to despair. So remember that shape, the final climb, the first big drop, that fake out rally, and then the catastrophic failure. That shape is the ghost we're hunting today. Okay, so let's jump into today. The last few years have been absolutely wild for the stock market. After the turbulence of the early 2020s, the market went on a historic run, with the S&P 500 posting stunning returns of about 24% in 2023 and 23% in 2024. As of October 2025, the market has kept climbing, tacking on another 15% for the year and hitting new record highs. What's fueling this incredible surge? Two letters: AI. Artificial intelligence has exploded from a tech nerd concept into the single biggest force driving global market. And the story is powerful and seductive. AI isn't just another innovation, it's a tectonic shift in technology, on par with the internet itself, promising to reinvent every industry and unlock trillions in economic value. The poster child for this revolution is Nvidia. The company's GPUs have become the new gold standard, the essential hardware for building AI. As a result, Nvidia's value has shot up in a way that just breaks historical charts. From a market cap of around $360 billion at the end of 2022, the company has exploded to a valuation of over $4.5 trillion by October 2025, making it the most valuable company on the planet. Its meteoric rise has pulled the entire market up with it. The so-called Magnificent 7 tech stocks, all with a heavy AI focus, now make up over a third of the S&P 500's entire weight. This extreme concentration and gravity-defying prices actions have analysts and institutions ringing alarm bells. In October 2025, the Bank of England warned that tech stock price blown up by AI hype could face a sharp correction if that hype doesn't deliver real-world profit. That feeling is spreading. Economists who called past bubbles are now warning that the massive stimulus pumped into the economy for over a decade has created a bubble of all bubbles, with AI just being the final speculative cherry on the top. The worry is we're in a full-blown speculative mania where the fear of missing out has steamrolled rational thinking. Just like investors in the late 90s threw money at any company with with .com in its name, today's market seems willing to pay any price for a piece of the AI dream. Valuations are by almost any historical yardstick stretched to the breaking point. And that brings us back to the main event, that terrifying echo from the past that's showing up in today's charts. Okay, so this is where it all comes together. We're not talking opinion here, this is about a pattern recognition. Market analysts have taken the S&P 500 chart from the 2007 to 2008 period and laid it right over the 2024 and 2025 chart. The result is what one analyst called an eerie similarity. So let's break it down. So first you have the build up. In both 2007 and the first half of 2025, the market rode a powerful wave of momentum. This is the final leg up, where excitement boils over into euphoria and everyone piles in, terrified of being left behind. The angle of that climb is remarkably similar in both cases. Second is the sharp peak. In October 2007, the S&P 500 hit its all-time high and then rolled over. In 2025, after a blistering run, the market also carved out a major peak, a point where the endless upward momentum finally hit a brick wall. Both peaks mark the point of maximum optimism, right before the first cracks appear. Third, and this is the most critical part, is the initial drop followed by the bull trap rally. After the 2007 peak, the market took a sharp scary dive, only to stage a convincing rebound in the spring of 2008. That rally clawed back a big chunk of the losses and led many to believe the danger had passed. It looked like a recovery, it felt like a recovery, but it was a trap. Now look at 2025 and its record highs. The market also had a quick pullback spooked by tariffs talk and economic jitters, but then just like 2008, a powerful rally took hold, propped up by the relentless AI story and the Federal Reserve hinting at easier policy. The market recovered much of what it lost, the bull trap was set. For weeks, investors have been comforted by this bounce, taking it as a proof of the market's strength. But if the 2008 parallel holds, this rally isn't a sign of strength, it's the final deceptive breath before the real plunge begins. Analysts looking at this overlay warn we are right now in the fragile moment mirroring the summer of 2008, the quiet before the Lehman Brothers storm. To be clear, a chart pattern isn't a crystal ball, but it's a map of investor psychology. And right now that map is suggesting that the same cycle of euphoria, fear and false hope that played out before the biggest crash of our generation is happening again, right before our eyes. Look, a spooky chart pattern could just be a coincidence, but it's not just a chart. Other deeply concerning signs are flashing bright red, adding a lot more weight to the idea that the market is walking on thin ice. The most famous of this is the Buffett indicator, popularized by Warren Buffett, who called it the best single measure of where valuations stand at any given moment. This indicator compares the total value of the US stock market to the country's GDP. Historically, a ratio of 70 to 80% is seen as fair value. In a 2001 interview, Buffett warned that when the ratio nears 200% as it did during the dot-com bubble, you are playing with fire. As of October 2025, the Buffett indicator is sitting at approximately 221%. That's not just in the playing with fire zone, it's the highest level ever recorded. It's higher than the dot-com peak and way higher than before the 2008 crash. It suggests that the stock market values have become completely unchanged from the real economy they are supposed to reflect. Another warning sign is fading momentum. Even with a string of seemingly good news like the Fed cutting interest rates for the first time in September 2025, the market's reactions have been getting weaker. Gains are packed into fewer and fewer mega cap tech stocks while the rest of the market languishes. This is a classic sign of an exhausted rally, running on fumes and vulnerable to a sudden change of heart. And finally, you have to listen to the people who saw this coming last time. Veteran investors and hedge fund managers who successfully navigated 2008 are now publicly sounding the alarm. They point to a mix of extreme overvaluation, speculative mania in one sector, and a widespread investor complacency as a dangerous cocktail that smells just like the past market tops. When you combine the eerie S&P 500 pattern with a Buffett indicator at all-time high and a weakening market internals, the case for a major drop becomes incredibly compelling. The data isn't just whispering, it's screaming that risk is at a generational high. We've just laid out some very serious data, and my goal here is to give you the clearest, most honest analysis I can. If you feel like you've earned it so far, please consider hitting that like button and subscribing. I pour hours into this research, into every single video to help you make sense of this chaotic market, and your support is what keeps this channel going. Now, with all this unsettling data on the table, the biggest question is, what now? Is a crash unavoidable, or could this time actually be different? To be fair, we have to look at the other side of the coin. History rarely repeats itself perfectly, and there are some big differences between today's market and the one that blew up in 2008. Ignoring them would be just as dumb as ignoring the warning signs. The biggest difference? The health of the banks. The 2008 crisis was fundamentally a banking crisis. Today things are vastly different. After that meltdown, regulators forced banks to hold way more capital. As a result, the big financial firms are much healthier and less leveraged than they were in 2007. We can see this in a metric called short float, which shows how many investors are betting against a stock stock. Leading up to 2008, the short float in the big banks like Goldman Sachs was huge, showing massive distrust from the pros. In October 2025, the short float in those same banks is near historic lows. This tells us the smart money doesn't see a systemic collapse coming from the banking sector this time. The heart of the financial system seems stable. Plus, some of the classic recession indicators aren't flashing red. While people are worried, corporate profits have stayed surprisingly strong, and the US economy is still growing. Some models that were screaming a recession in 2025 have quieted down, now showing a lower probability of a big sell-off. Finally, the thing everyone is speculating on is different. The 2008 bubble was built on bad debt and financial smoke and mirrors. The AI bubble, while definitely frothy, is built on a technology that is undeniably real and transformative. As some tech leaders have pointed out, this might be more of an industrial bubble than a purely financial bubble. The idea is that the excitement is getting every experiment funded, both good and bad. While a lot of these will fail, it also speeds up real innovation that will create lasting value, just like the internet did even after the dot-com bust. So when you add it all up, stronger banks, no clear recession signals, and the fact that AI is a real game-changing technology, it builds a powerful case that maybe this time is different. It suggests that even if we get a big market correction, it might not be the kind of systemic economy-shattering event we saw in 2008. So where does that leave us? On one hand, we have a haunting chart pattern staring us in the face, a direct echo of the 2007 to 2008 peak. This is backed up by the most extreme valuation metrics in history, like a Buffett indicator that's screaming you're playing with fire. The market concentration in just a handful of AI stocks has created a level of risk that is by any measures off the charts. These are the classic ingredients for a major market top. On the other hand, the core financial system is more solid than it was in 2008. The economy is still chugging along, and the speculative mania is wrapped around the technology that absolutely will change the world. The takeaway here isn't to panic, it's to prepare. The evidence overwhelmingly suggests that the market is priced for a perfect future in a world that is anything but. A significant correction, maybe in the ballpark of 30% or more, seems not just possible but highly probable. The easy money from the AI craze has likely already been made. The next chapter will be defined by volatility and the return of risk. This isn't a prediction of date or a price, it is an assessment of risk based on historical patterns and hard data. Being prepared means understanding that the potential for a drop is dangerously high. It means looking at your portfolio, making sure you're diversified and not being over leveraged in the riskiest concern of the market. It means being mentally ready for a time when the stock price don't only go up. The ghost of 2008 has returned, not as a guarantee but as a severe and timely warning. Heeding it is the first step to navigating whatever comes next. But that's my take based on the data we have today. What do you think? Are the parallels to 2008 too strong to ignore, or are the difference enough to believe this time is truly different? Let me know your thoughts in the comments below, and I'll see you guys in the next video.